I'm down here in Jupiter, Florida, so I'm sure you all have been kind of watching the news, but we have this Category 4 that's literally coming tomorrow. So I've been running around all morning, boarding up the houses, and probably be hitting the road a little later. So, yeah, I mean, I'll probably, I'll follow the similar format. I'll just give you a quick rundown on. I mean, that intro did a great job. Appreciate that. I can just give you a little bit more of my background. And then the topic today is, I built my trading model, and I kind of built the early part of my career on a lot of technical analysis, and I would basically cover all the rates traders. I talked to the heads of the desk at pretty much every primary dealer. And I started trading treasuries and fixed income really right out of 2007, right into all the mess in 2008. So I kind of had a front row seat to, kind of the end of the world at the time. If a lot of you guys were trading that time frame, I mean, we don't have to go into it. I'm sure a lot of you realize how crazy it was, but some interesting stories there. But what I would do is mainly spend the majority of my morning doing analysis for the banks, and I would cover the entire yield curve. So, both cash futures and but across the whole curve. So from 2s to 30s, and throughout that process, not only would we give them levels and talk about, it was all directional analysis. So part of what I want to share today is how I derived that model. A lot of traders found it valuable because what we incorporated and what my firm does is not just about technicals. We pretty much do zero fundamentals, but we incorporate time. And so I'm going to talk a little bit about the basics of that. I think it's something that the industry overall needs to evolve to the point where, yes, price matters, but we also have to realize that there's this component of time and across different time frames, and that's kind of the cyclical nature of markets. And cycles is not just about highs and lows, it's more about the rhythm of time. So that's what I based a lot of my work off of, and then I have a lot of trading experience, but everything I do is directional. So that's the basis of what we'll be going over today. And then at the end I'll talk a little bit about what my firm does and kind of what our mission is and what we're building. So along the way, if you have questions, I'll try to keep an eye over here, but maybe we should probably save most of that towards the end. All right, guys, and then hopefully I can get to as many questions as possible. So I'm going to kind of go through some of these slides, things that I think are most important. All right, so let me just talk a little about the origins of our model. And again, we're going to talk about this concept of time. And so over the years, I mean, the way we kind of approached the markets was from a physics standpoint, thermodynamics. So it's my opinion, and kind of my firm's opinion, is the way we trade is we look at the markets, and it's all about energy. So yes, there's emotions, right, greed and fear, but at the end of the day, it's energy that's moving through the markets. Just like the waves you see in the ocean, it's not necessarily that the ocean is moving. It's the energy that's passing through the medium. So everything moves in waves and cycles, and the world is comprised of these complex, dynamic, cyclical wave formation vibration. And that's, to summarize that, I mean, without going into the physics, but that's true throughout the universe. So, if you guys have kind of read any of the news lately within the last few years, scientists actually discovered that even gravity moves in waves. So the way that this applies to markets is when you understand that these patterns are moving throughout not just nature, from your heartbeat to just cycle of life itself, weather cycles, I mean, everything cycles. So we've identified these patterns over the years, and we also realize and come to know that they're fractal in nature. And what I mean by fractal in nature is, So we look at the markets from different time frames, right? So the trends on the monthly level will build into the trends on the 1 minute. And you can find that same type of structure in nature. So there's some examples of this I could touch on in the slides a little bit later, but some of the best examples, I mean, if you look at a coastline, you can see the similar patterns that build into the larger patterns. You know, one of the best examples is a fern leaf. If you take a look at the actual leaf of the fern, and then you take a look at that pattern, it's the same pattern as a branch, which is the same pattern as the overall tree. And it's the same in markets. So we've identified these patterns over the years, both from a cyclical perspective, but also from a technical price directional perspective. And we use the same model, and why it works so well across any market and any time frame is because we noticed that the same model and process works on the 1 minute, works on the 5 minute, the 15 minute, and so on. So part of the cyclical wave structure, and just a little bit of history, you know, we can look at the business cycle, and there's been a lot of work on this, but the waves of creative destruction are pretty well known. But most of the work that's been done was by a firm in the 80s called Princeton Economics, and there was a great trader there. He's pretty well known throughout the industry. If some of you are listening, probably know him, Martin Armstrong, but he coined the business cycle, which is 8.6 years, and it's the same wave formation, and he found it by studying financial panics, and he did it over a period of 227 years, and then he found that these financial panics came about on a rhythm of 8.6. And so then he went on to build a massive computer, and he had assets under research of, you know, well into the trillions, and this was in the 80s. It made him one of the biggest Forex analysts and forecasters. So we took some of that global macro approach to the markets, but then we also dialed it down to the near term, all right? And so again, we found that it was a lot of the same things you find in electric and magnetic fields go on in the markets as well. So you have not only do you have price cycles up and down, but you also have the volatility band that is acting similar to the electromagnetic field that we see in other physics realms. All right, and so here's a look at what that looks like. All right, so there's actually a third component of this. It's called the schema frequency. That gets into a little bit more of the algorithmic stuff. I mean, you really need a high-powered, you know, computer database to kind of run some of this stuff. Sorry, I'm just looking at a couple of the questions, guys. Try to keep up with you. So as we kind of move through this, what I've found, you know, back on the Treasury desk, I would share this with a lot of the hedge funds. We would go through some of these concepts, and there's an 8.6-year frequency. And for the sake of time, I really can't get into all the different derivatives, but that builds into a 51-year wave. All right, but what it kind of looks like is you get into a scenario like this. And what he found and his firm found is that you're always having these shifts between public confidence and private confidence, right? So trading is really, you know, it's all about confidence. It's a lot of perception of what the market, you know, thinks is going to happen actually matters more than the fundamentals or what is really true. It's really more about the anticipation of what the market perceives to be true that matters. So it's always these swings back and forth, and these waves build into larger waves. All right, and so this is kind of what he found. So currently we're on I think you can see this here. 2015 was the peak in this last business cycle, and we're currently in a private wave that should peak into 2032. And it's at these turning points where you get substantial highs and lows in markets, and what you'll tend to see happen is that capital will concentrate. First, it'll concentrate into a sector, or I should say a country, a certain part of the world, right? 2007, the capital concentrated in the U.S. and then specifically the real estate market. So you get capital will fly around the world, and a lot of times you can see that in the currency markets. We trade a lot of currencies. That's probably about 75% of what I trade, and that's meaningful because of the capital flows. But where you get these bubbles is when the capital will concentrate first in a country, right? Which means it's concentrated in that country's currency. So you're going to see that express itself in the charts. But then you also get a lot of times it will concentrate in a country, and then it will do it in a specific sector or asset class. And then you just have these shifts, global macro, and these long-term trends where capital is just moving back and forth. And so we find these cycles, these longer-term cycles that play out as well. And so here's some examples of this. So I went through some examples of these scenarios on the charts, but I did this, I don't know, 5 years ago. So some of it I haven't updated in recent years. But in line with these cycles, guys, you'll start to see that, you can start to see the peaks and the troughs in the different markets. And one of the things that I always teach folks is you kind of got to understand the concept of cycles is not about highs and lows. It's about a rhythm of time, right? It's a rhythm like a metronome. For those of you that maybe are into music or musicians, when you start to think about cycles as turning points, right? Turning points where the trend may change, specific highs and lows often happen at the turning points. But there are a lot of times where you can have a cyclical peak, okay, and everything is connected. All the markets are connected, all right? So you might have a peak in the dollar at one specific turning point in the cycle, and then you may actually have a low in something else like gold or oil. And so when you have an idea of where these turning points are, and it doesn't have to be just on a yearly level, it can be on the hourly chart, a daily chart, and that's some of the things that we work on, is when you know where these turning points are, you have a good feel for where the market might trend to, and then actually you'll see a turning point around that specific point in time. Or it's good for just knowing, where your stop might be, where your risk is, and it's important to just have a feel for time, because really time actually matters more than price. And so here's some examples, and it's amazing. You'll start to see these exact highs and lows take place in the market sometimes to the day. So at the bottom of this cycle, the 8.6-year cycle in April 1994, you had the exact the low in U.S. equities. If you looked at the Dow, that was April 4th, 1994. All right, then you moved into two minor turning points. The Asian currency crisis was in 97. We moved back to the highs in 1998, and you had a high in the Dow exactly to the day. All right, it doesn't always happen exactly to the day, but you'll see on a few others of these slides just how fascinating it is. It really shows you that there's an underlying structure to the universe, that it's not just about price all the time. All right. So on the downside of this wave is where you have Russia collapse, and that was long-term capital management that ended up taking the blunt of most of that. The debt markets of Russia when those blew up. All right. Then on the next turning point, you actually had the low in gold. That was a 19-year bear market. The internet.com bubble peaked 2007, pretty much right exactly with the turning point. Stocks bottomed again in 2002. It was an October low. All right, then we moved into the peak in 2007, and the U.S. Dow Jones Real Estate Index, guys, it topped to the exact day of the cycle, 2007. I think it was, I forget the day, but you can go back and look at a chart. I think I might have it on the next few slides. All right, and then on the downside of the wave is usually these are collapses in confidence when you go from a high to a low, and so that's when the banking crisis started. A lot of bad things happen, All right, and then 2009 we had the bottom in U.S. real estate, and then actually to the day is when the sovereign debt crisis started, and Greece announced they were going to get their first funding from the IMF, actually to the exact day. And then commodities peaked on the next turning point down here, 2011. All right, so I'm trying to go through this quickly, but I think it's really interesting history for those of you that like history, but you can also kind of go back in markets and see these same kind of things. So here's an example of what I was saying in real estate, right? So you can see I drew the 8.6-year wave formation, and there's your exact top. Again, Dow Jones U.S. Real Estate Index. This is on a Bloomberg chart. I don't have the header up here. But that was to the exact day. And then, boom, you had a reaction low with April 2009 being the exact bottom on the turning point. So this would be a good example of where I was saying that you can have a peak in the cycle, but it's not about price, right? You can have a low with the turning point, even though the turning point is part of the high cycle. So that's a perfect example. That's called a cycle inversion. And so these are the things, again, that we kind of pride ourselves on. All right. This is some of the most recent. I've been meaning to go back and do some of these turning points in some other markets. I don't have that slide done for today. But again, here in 2011, commodities peaked. All right, gold topped pretty much right behind the cycle. The end of Fannie and Freddie on 2013. We had the monthly closing high for 10-year bond yields. That was also with this peak. And then they've just been collapsing ever since. And then you had the euro. The euro started its big move on this turn. And that, because everything's connected. So as soon as the dollar broke out, the euro broke down. It was all right around this turning point. And then that's been in place now for probably into 2017 is kind of our next target. Someone was asking if ECM, is that an average of the main indexes? No, it's not a. It's not about price. Again, it's just a wave structure of time. And so, just like you have a sound wave or you have a longitudinal wave, I'll show you this the stochastic oscillator that we use. But it's not used for price, so it's not an average of the indexes. This is a rhythm of time, so it's just an overlap of an oscillation. It's actually not derived by price. We just use price to find the rhythm. I hope that makes sense. I can maybe kind of address that as we go. I might answer that question a little bit more thoroughly here as we move through this, but it's a good question. So here, guys, is another, this is, I went back and did this, and you'll see, it seems like there's a lot on this chart. Let's see if I can move that without screwing it up too much. So here's the same rhythm, right? Just like your heartbeat. Looks actually very similar. And so again, we're looking at turning points. So here in April 19, this is 1925, guys. So I went back and looked at, you'll see these are some crazy moves, during the Roaring 20s, we had the Great Depression. But you can see that there's this, again, this underlying cyclical structure to the markets. And again, part of the mission of our firm is we don't really feel like that's something that the majority of traders, the majority of Wall Street, the majority of the profession have really looked under the hood. So I think that's kind of the next wave of innovation for our industry, is we got to get this concept of time down instead of this linear thinking where it's just constantly projecting forward. Oh, the market's a bull market, it'll never go down, real estate never goes down, and we all know that's not true, right? So again, this is kind of interesting. This is April 1925 at the bottom of the cycle. You had a top here, the 1919, 1920, and the Dow actually broke out with the bottom of the ECM. And then sometimes this is really cool when this happens, but when you get a low with the cycle and it actually peaks out in price to the exact point of the turn. So this went for a full cycle, 4.3 years from the trough to the peak, right? So when it broke out to its high, it was exactly in line with the cycle. It's pretty amazing. So that was a heck of a move. So the way you trade it is we have a technical and a directional model that's very much about price, all right? And I think it's one of the best trending models that's out there. But if you know that a market breaks out with the bottom of the cycle, you can be much more confident that you want to be thinking long term, you want to be keeping a core long, you think this thing can go, at least to this turning point here in 1927, but maybe it'll complete a full cycle right into 1929, and if that's the case, there's some other techniques and a trading model that we use, but just by looking at this moving average, you can see that this thing stayed in a power trend all the way into the highs of September. All right, and then it dropped basically into this turning point, made a low just right after that. All right, it based into 1934. And then it broke out again, and it peaked with the turning point here, April 1937. All right, then it's kind of went sideways here, but the next big turn again was 1942, and again you had a rally basically into the top of the ECM. Looks like that was 1947. All right, guys, then again you exceed the highs. Look at this, exactly with the bottom of the cycle, boom, and then the market exploded in the 50s. All right. This is an example of a chart I drew in Bloomberg I drew this back in 2013 or 2012. And so I shared this with a lot of our hedge fund clients at the time that this was a pretty predictable path that we might be on. So we were looking at turning points here. Obviously this was the peak in 2015. And if you actually look at the Dow now, this was a pretty good, we basically struggled right up here just recently last year. All right, so this is kind of a way we map out the longer term cyclical structures and some of the things that we look at. Trying to see how I'm doing on time. So let me touch a few more things on our model. I think I kind of painted the picture of just the 8.6 year frequency, how powerful it is. We use a lot of which I call Pielines in our trading. And to boil it down, I mean, everyone pretty much knows pi from a mathematical, frame of reference. Anyone that's pretty well educated understands this, right? So pi is basically it's the perfect cycle, right? If you unravel a wheel, that circumference, right? Pi is what it comes out to be. So from the start all the way around the cycle to the end, back to where the cycle started is pi. So it's the perfect cycle. And which is interesting is when you take that 8.6 year frequency, it actually comes out to 3,140 days. And that's pi multiplied by 1,000. So there is lots of examples where you start to realize underneath the markets of this cyclical nature, and it's just the way it is. And once you realize that, you can really add that type of edge to your trading beyond just the simple things of technicals and all the different indicators that are out there. I think that once you incorporate time, you find some pretty amazing things can happen in your trading. So this was just another example, right? 8.6 years is equal to the perfect number of pi times 1,000 days. I just said that. But 8.6 times 3, guys, is 25.8. And when you look at the axis that the Earth rotates on, it's actually a period of 25,800 years. All right? That's the precession of the equinox. So again, that's your cyclical nature, and that's an example in the cosmos, really. And so then I teach this in our model. This is part of how I developed this. So this is an example of sine cosine waves. And again, you can see that these waves are built on pi. Right? So the oscillation is actually a period of 2 pi. And so what I like to summarize this as, there's an underlying structure of not just geometry, which we all learn in school, but you have to understand that there's a geometry of space, which is what we're taught, but also time. So this is time, as we move from left to right through time, right? We're getting these wave rhythms of time that are also based on pi. So I won't spend too much more time on that. Kind of what I touched about earlier in the session was the fractal nature of time. Let me just kind of, what do I mean by fractal? You guys can look up on YouTube. There's a scientist named, well, he's actually a mathematician, not a scientist, Mandelbrot. And with the advent of computers, in cycles, there's an iteration that goes on, and this is the same thing we find in nature, where one pattern will kind of iterate it on itself. And what that does with computers is the computers can go and infinitely create a pattern that never ends, and it's just all about iteration. But the concept is that you have these smaller patterns that build into the larger patterns, and also vice versa. The larger patterns, as you zoom in and zoom in and zoom in on a more minuscule level, you can see that it's the same self-referring process. So that matters in markets because we found that the same thing that works on the 5-minute in our trading model works on the monthly chart. And I think a lot of people understand that. If you have a good model, it should work on multiple time frames. So this is the gentleman I was speaking of. Here's a picture of the guy right here. And this is all about complex dynamics. But again, the key point here is that it's about time and it's fractal. So there's a self-referring process. So we've studied these qualitative behaviors. In physics, it's called the equations of motion. But a lot of these same concepts, phase transitions, these all show up in markets. This is about the strange attractor. I won't get into that. I don't have time to discuss that. But here you can see I'm stressing time. So I'll show you on examples of some charts here. But when we get into the markets, we work our size and our trading based off of, if we're early within the cycle, you need to have a specific parameter about being early and keeping your size the right way. I teach a lot of coaching with traders, and I work with them on this, of how to know when you're early, how to build your position correctly. You know, a lot of traders average into their losers, which is not necessarily wrong, but most traders don't do it correctly. They get way too heavy, way too early, and that allows them to not be able to stay in the trade. But then that's a point in time where we realize that we might be getting a turn, so we'll play a contrarian, and that's how we build positions. That's how we pick off the lows a lot of times. And then we are also paying attention to that, again, that factor of time to know when we want to start coming out of our position before the trend changes. And that's the only way you can really get that down, is you have to understand these concepts of time. So here, one of the equations of motion, there's different classifiers, but the main one that we find that there's a lot of great indicators, but oscillations is the key that we like to use in our trading. So here we can see some different rhythms or different cycles, right? Sometimes they all line up. Sometimes they're interfering with each other. So I like to use the slow stochastic. It's a simple indicator, been around a long time. But the reason I teach it and what in our trading model, and we have an alert service too. It's called the Active Trader or Active Trader members, and we send out alerts on swing trade, day trade, forex, futures, the bond market. I mean, I trade a little bit of everything on a lot of different time frames. But what I teach my traders is that we're not trying to use the stochastic as an overbought, oversold. So sometimes you'll hear traders say, hey, the slow stochastic is high, you know, it's overbought up here, and that's actually the incorrect way to use it, because this oscillation, again, is a rhythm, and we can see that rhythm. But this is what this is measuring is more important, is the time factor. So you can have a market that's actually oversold, right? You can have a market that's crashing, coming into the high of a cycle. So that doesn't mean that the cycle is overbought, because technically the price is very oversold. So this is about being high within the cycle, but it's not about price. Does that kind of make sense to everyone? I know I'm kind of flying through this, but so that's one key takeaway I would share with you today, is don't use the oscillation as overbought, oversold. You need to use it as turning points in time, and you'll find your trading, you'll start to see some things unravel that are much more important. So this is some more of the physics behind cycles and how to structure these types of systems. Here was an example of that firm that I brought up earlier. All right, even our DNA is a self-referring process. I won't get into that, but that's the Latin term fractus. So we come from the structure of our parents, right? So the DNA is a self-referring process, but it's the same thing in markets. All right, so why don't we jump into some of the charts real quick? Does anyone have any kind of questions on some of that overall background of our model, and then I don't know, anything on the history of some of the markets we went over? All right, let me just grab a sip of water. Is my audio still all right? All right, cool. Yeah, guys. So here's the model. Technically, just summarize them, and we have a technical and a cyclical model. It's directional, all right, and it's for any market. And what we try to do is we seek and define repeatable edges as it pertains to price, and then we have a proven risk management process. So it's one thing to be good on the charts or have a nice edge or a nice signal system. It's another thing to know the right way to apply your risk, and I think that's where a lot of traders fail, and that's kind of what we bring to the table at our firm. Is you could be right on the price level, you could be right on the trend, or even from a fundamental perspective. A lot of traders are so focused on what the fundamentals are that I would just argue, if you're too early, and the market's moving in anticipation of things, whether or not they're actually true or not. But you could be early in your timing, and if you don't know how to work your size and you don't have a good risk management process, it's not going to matter. You're going to be right in the long term, but you won't be able to stay in your trade. And so that's kind of what we work with traders on about, it's part of their trading plan, etc. And I talked about the model's fractal in nature. Yeah, that's our fractal top-down directional model. I do use, a couple questions, guys, real quick. So I'm not just ranting. So yes, the question was, do you use multiple time frames on stochastics? And yes, absolutely. I'll tell you this. So I tend to break my trading up into three main time frames. The long term, which I take core positions in. All right. So a core long-term position for me could be anything for 3 to 5 years. Like right now, this year, we just started building a core long-term position in gold and silver. I like the metals long-term. I've been bearish since they broke down in 2013, really, 2012, 2013, and then we flipped bullish this year. And there's some other reasons for that. But our long-term time frame in our process is, our long-term is considered several months to several years. You know, the swing trade time frame is another time frame, the intermediate term. All right, that's anything from several days to several weeks. All right, and then the near term, when we're day trading, is several minutes to several hours. All right, so that's pretty common, but when the question about the stochastics is, if I'm taking a long-term position, I look for where the cycle is on the weekly and monthly, and then that's where I start my trade from, and then I try to take out these chunks of time. I might be able to show that on the charts here at the end. Come back to that. When I'm day trading, I'm really paying attention to the 30-minute and the 15-minute cycle, and I'm trying to take out chunks of time. It's usually 1 to 2 hours, and then as that cycle changes on the 15 and 30-minute is when I start to get out of my position or lighten up, move to a certain type of trailing stop method we use. So yes, absolutely, it's all fractal. So yeah, we're using stochastics on, and you know, in the 1 minute, the stochastic on the 1 minute is oscillating. So we bid an offer around our core position, even when we're day trading, and I'm getting hit on bids, I'm lifting some offers, you know, and I'm trading around the 1 minute cycle, even though I have a core position maybe on the 15-minute. And that's how the true pros trade. I mean, it's not one price in, one price out. That's pretty amateur way of trading. You want to learn to work your position. Did the model catch October 87? I can't recall offhand. I'm not sure if it did in the Dow, but I think it did in the dollar. Right before that, you saw the currencies all kind of turn. That would be a great thing for me to work on, though. I wouldn't be surprised, actually. I mean, it picked off pretty much the high in the Russian market. If you remember the ruble, and that market was going nuts. So I touched on this. Trading its purest form is really a psychological and confidence game, but then what we drilled into over the years was pattern recognition, and then again the cyclicality of it. So I have a 3-part model. There's 3 pillars: analysis, execution, and again risk. So the analysis, the key is defining the edges, and that's just where you have a higher probability, showing you where the trend is. You know, you want to use 80% of the time you want to be with the trend. And then there are points in time where it does pay to go a little contrarian, or to start exiting your position as well. And then we also have execution, which we really focus on. And this would be an example here on the chart. I guess I could use a pen, right? Right. This is a bullish engulfing setup. I call this a swing line. I can show you guys on some other charts. It's a little bit easier. And then when you take out this previous high, we would buy this candle. Any more risk that we added to this trade, stop below the low. All right. Here you can see we're on a count. That was probably an 8 count. If any of you know Tom DeMark, you see the same kind of things that kind of unfold in his process. He uses an 8 or 9 count will show up, sometimes a 13 count. So even his stuff picks up the same kind of things that we focus on. All right, let me try to switch over now to to one of my trading screens here. Hopefully I teed up correctly. Well, if I lose you guys, just 1 second. How's that screen share? I think this is a Novi contract in oil. Does that look good, everybody? You can just put a Y in the room or N for no. That would be helpful. All right, cool. Okay, guys, appreciate that. Thank you, guys and gals. So I have about 15 minutes, and then maybe we can do some more Q&A. I can explain some of what our company is all about. So, well, let me just show you some of these examples here. This is the Novi contract, right? November. We've sold a high both times here this year in oil, and I would argue that most of the trend following people didn't have the highs up here because their models are still telling you to stay long because they don't see the cycle turning in time. And you got to kind of be able to put everything together underneath the hood on the different time frames. But point being is, there's a lot of different techniques I teach. You can see this red line is actually a 2 standard deviation model. And so what I used to work with hedge funds and some of the fixed income guys on the big desks is that there's a rule in statistics that's called the 3 sigma rule. And what that means is you could look it up on Wikipedia or just find on the internet, obviously. The 3 sigma rule states that the majority of a data set, the sample set, the majority of your statistics is going to fall within 3 standard deviations, and it comes out to, I forget the exact percentages, it's like 99% in a bell curve. You're going to have the majority of your data is going to lie within 3 standard deviations. And so for those of you who aren't familiar, standard deviation, you can run this on multiple trading platforms usually. This happens to be Thinkorswim. But you just run the channel and it'll pick up the mean. And so standard deviation is just trying to figure out where the upper and lower bands are from the mean. And so the 3 sigma rule would say that the majority of time, this is set at actually 2 standard deviations. All right? And I use that because it's actually 97% of the time most of the market's data will fall within 2 standard deviations. Now, obviously, there's lots of times where it can move outside of that. I mean, during the flash crash, there was moves in the bond market and really even, of course, the equity market. So you went to 6, 7 standard deviations. I was trading the 30-year that day, and the long bond dropped about 6, 7 points, and that got down to 6 standard deviations, which was just crazy. And when that happens, you either get a snap back to the mean, or you have to go sideways for a period of time and let the market catch up. But anyway, so we like to use the standard deviation channel because you can see here it captures the ranges very well. So you just drag this across for different time frames. But that helped us cover a lot of our core short down here, right in front of 40. All right, and you can see how it was containing the upside here as well. But anyway, when we were approaching 50.51, we had a nice call back on the monthly chart. If you guys want to think back to that cycle, the 8.6 cycle, we knew that once the cycle turned, and you broke what I call the TMS here, which stands for technical market structure, but this is how I define a trend. And I'm looking at the higher lows. These bands, these are called exponential moving average bands. Yes, sorry guys. The question was, what platform is this? Yeah, it's Thinkorswim. I have a few different ones we use, but I like this because they have a nice band structure. So again, if you guys think back to wave formation vibration, which is what energy is, that's how energy moves, you get these waves. And so I like these bands because it gives you a good visual of the human eye of the wave formation. So when you roll over, you get a downward looking wave, right? When you get in a range trade, these bands will get really tight, and that becomes very obvious to the human eye. But without going in too much detail, which I teach, again, our traders in our model, is when you get a TMS break like this and you get a monthly close below these lows, we knew that if we didn't hold these bands, we were going to get a test most likely of the 200. And then this dashed line is what I call the pi line, and that's a discovery I made. Everyone uses the 200 period moving average, but no one uses. I mean, I hardly ever see anybody use a moving average beyond 200, and if they do, they usually just go 100 by 100. But if you want to put something really helpful into your trading tomorrow, you know, that I'm sharing with you for free, basically, is that this is the 314 period moving average, which it's a simple concept, right? Pi is 3.14. Take that times 100, and I'll just say too, real quick, guys, the thing about moving averages is everyone has them, but a lot of people use them the wrong way. I would say that a moving average cross is detrimental to your trading because it's just late. It's a very late indicator. It takes a lot of time for a moving average to cross. I started my trading trying to do that, and I just found that I didn't like it. It didn't work as well. That's just my opinion. But the moving average is not about just a point on the chart, guys. It's not just a price level. I mean, yes, you can follow it, you can trail out on it, you can even look for highs and lows around it, which we do. But I like to argue that it's more about the time piece, right? Because this moving average is accounting for a certain amount of time. And so again, if everything's cycling, you'll find in markets that price will move back towards the pi line, it'll move away from it, and then it'll cycle back to it. I can show you an example of the pound where it failed exactly at pi, right in front of Brexit. We actually sold there. While everybody else was probably chasing breakout, we were going the other way. And I would say this is the same thing here. When you got back to the 200, nobody had pi down here really for a place for the market to turn, and that's exactly what happened. So anyway, we had a good call here longer term. That was like once we broke these upper bands, you could fall to the lows from 2008 and maybe complete a pi cycle. That's what happened. All right. Now you can see here the cycle moved up on the monthly, turned, the market turned, and then it cycled all the way back down to the lows, which was pretty much the bottoming tail we had earlier this year. Okay, there's a great visual just on the monthly level. We go to the weekly setup. There's lots of things I could teach in here, but the reason why we were pretty confident in shorting, even when you have to remember that we were trading a different contract at this point, but the market actually pushed through 50, and I think it went to 53. I can't remember exactly on what contract. But the reason why we were shorting up there and building a core short is because we were at the top of these bands, and this is why we use it. It just works great. It shows us where the edge is. All right, so we were able to sell the high, and we did it again when we rallied back to it. And now this is actually the third test of that same location. And I put on a put ratio back spread today after the oil inventories number. Weekly chart. Oh, excuse me. This is the daily chart. Hey, John. Yeah, the question is, what period do you use for the STD, standard deviation? Is that what you mean? I like to use 2. Sometimes if a market falls in a tighter range, I'll slap, 1 standard deviation on there. But the 3 sigma rule would say that it's real. If you put 3 on there, it'll be really wide, and that's why you'll find 99% of the price action falls within the 3 standard deviations until the market turns, right? And then you got to kind of set the new range. But here it is again on the daily. So this is what we're working with, right? I haven't drawn a new one drawn just yet. You would draw this sideways. You guys see how the bands have tightened up? So this is more of a range trade. So if you were to drag this, I don't know. Let me just see if I do one real quick. So that's 1. Change this to 2. All right. So some people might be panicking if we get through this high. We won't be. We actually expect the market to run these stops above this high, and then you want to actually be fading that and looking to keep your core short or swing trade short up from the top end of this range. Again, you have all this resistance back from earlier in the year too, so I expect the market could push a little bit higher. I would say now on the cyclical time frame, we're very close to rolling over on the daily. I'll teach you guys something. I'm not sure, John, the question, how many bars? I just drag it over the trend. I just eyeball it, so you don't actually have to put in how many bars. I just eyeball it. Like here, you know, you can just see that this is the range. It just comes with experience, I guess. If you drag the longer term, like on the weekly or monthly, you could probably get the top end of the longer term range somewhere in this area also. But that would be really for more institutional people. I mean, a lot of us independent traders or the smaller professional, you know, unless you're a commercial type of account, you're really probably not shorting a bunch of futures up here long term. But anyhow, so basis, and this was one of the questions earlier. How do you go from the swing to? How do you get those green bands up? The question is, how do you get those green bands up in Thinkorswim? They're on there, guys. If you look under the studies, I think it's look under E, the section under alphabet E. It's EXP ribbon or exponential. It might be moving average ribbon. I think they abbreviate it. I don't want to search for it because I only have a little bit more time here with you guys. So you start at the swing. So yeah, so I'll show you what I mean. So here's the daily cycle, guys. I like to use a 5 to 3 metric. A lot of them will go 10-10. I use 5-3. It just seems to be a better rhythm. All right, and I really pay attention to the slower line, which is the red, %D, because the human eye will see this blue line and it'll look a lot higher than it is, and meanwhile the cycle reading might actually be in the middle. So you really want to pay more attention to the slower line. But when you get across, when you're high within the cycle like you are right now, you want to be, if you're long down here from good levels, you want to be coming out of your long for sure up here. But my traders know that, yeah, we sold a little bit towards the top end of this resistance, but we're only selling about 20% of our average position size because we know that time hasn't played out here. So when we get more of a signal here from this oscillation, then what we do is we drill down to the 4-hour chart. All right. Let me kind of move this. Can't see everything here because I got the control panel up. So we're kind of prepared to, again, run these stops maybe through 50, but then you want to be going the other way around up here around 51 or so. So when we go to the 4-hour, it's the same thing now. Here we're high within the cycle. All right, you're actually overbought. This is an RSI reading. We'll tend to use that a little bit. But then I'm looking at the trend, and I'm watching for this 8-period moving average, which shows you the immediate trend. All right, and once this breaks, then we're going to get more aggressive on our size, because what we're trying to capture, guys, in the markets, again, if we think of the wave structure of a cosine like this, what you want to find in your trading is that, I mean, I only know this because I've done all these mistakes, right? And I've worked with traders on the same thing. You can get into a lot of trouble when you're early, and that's what I call the left-hand side of the chart. It's, you know, it's kind of like, oh yeah, it's obvious. But I'll guarantee you that traders were shorting here were way too early. And so how do you identify what I call the right-hand side of the chart, which is where you want to be aggressive? So I teach my traders you want to have 80% of your risk or your position size on the right-hand side of the chart. Okay? Here, you're putting your toe in the water, right? but you need to understand and know when the trend actually changes. And I teach that in my TMS portion of the price part of the equation. All right, but here we're still on the left-hand side of the cycle. So we don't know if it's going to stop at 50 today, 51. But we can be pretty confident that we're closer to a turn based on the daily cycle and this 4-hour cycle, that there's a lot of room to cycle down in time. All right, so you can see that this 8 is rising. So we put some puts on here, but again, I'm keeping it small because I'm thinking 51 we might even stretch to. And again, we'd probably run the stops through the highs, which anyone that's traded professionally, you know that the market likes to go where, you know, people feel the most pain, just how markets trade, right? So the most pain would be through these highs. People stop out, boom, then you get your high. So I teach my traders to have that type of thinking. So it's a patience thing, it's a cycle thing, it's a fractal thing. Then we would move to, you know, the hourly time frame. A couple more questions. What are the moving averages? Okay, good question. This is 314 period moving average. See that right there? This is the 200. This is, again, this is the wave formation. Now, if you don't have a platform, sometimes you got to go in there and build your own. I've done that on FXCM. I don't think MetaTrader has one either. Some of you guys are better at that stuff. You can find anything and plug it into MetaTrader. But you can build your own by using moving averages, even just using a simple moving average, and you space it out like 5 or 10. I think there's 8 of them here. 1, 2, 3, 4, 5, 6, 7, 8, 9. All right. This blue line, I know it's a little harder to see. That's the 30-period moving average. We use that a lot on the treasury desks. And again, I like the 30. Everybody has their different preference. Not because it's a magical moving average, but because 30 actually lies within 2 standard deviations when you're looking at something like a Bollinger Band. So what we've found in our back tests and experience is that you're going to get higher lows when you're in an uptrend at or near these moving averages. So we don't buy in front of the moving average and say, oh, it broke the moving average and stop out. That's kind of very novice trading. We look for higher lows at or near the average, but we're not afraid of a deeper pullback below the average. Good thing. So some traders, you know, as soon as they buy or execute in the market, they immediately want the market to go in their favor. That's actually the wrong thinking. You want the market to pull back in your favor when you're in an uptrend. As long as deeper it goes without breaking trend, the better. All right, that allows you to build your position and get a bigger position and to capitalize on the next ebb and flow the other way. So again, that kind of gets into some timing strategies. And then this green line is the 8-period moving average to answer that. But I keep it pretty simple as far as indicators go. Yeah, this is Thinkorswim. Fibonacci ratios, yes, I do. I actually eyeball it, Fibonacci, believe it or not, more than anything. And what I mean by that is we're coming up here on probably with the Q&A session. I guess I'm kind of already doing that, but guys, I look at the market in terms of walls. So when we think about Fibonacci, Fibonacci's great because it's picking up on some of the fractal things in nature. Everybody knows Fibonacci was a mathematician who who discovered that there's these ratios. It's all very similar, and it's very cyclical. So what I do though is I look at the market in terms of walls sometimes. So when I see that the bulls have built this big wall, this is essentially all these little candles. If you change the time frame, guys, right? This is one giant candle, right? This move up. Well, when you have a bullish move up like that, 50% retrace or a 618 Fibonacci is typically where the market will pull back to. So when we find these walls like this, we don't get aggressive up here around the 8. We're trying to work most of our size halfway, again at or near the 30 or below, back towards these bands. All right. Again, here's a wall about halfway. Boom, get your higher low. So you could draw Fibonacci on that type of stuff. But I just know from experience and looking at charts every day, all day. I used to work orders and trade. I mean, I would give orders to Goldman Sachs, RBS. I mean, 200 million tens, and I would work orders in Tokyo with guys in London. So I was a pretty big institutional trader, and I don't mean that to toot my own horn. I'm just saying I know how to trade risk. I know what it feels like to be too heavy. I know what it feels like to be on the bid and I was the only bid in the treasury market sometimes. I know what it feels like for your computer screens to crash. You're long 100 million tens and the market goes down 6-7 ticks. I mean, you can be out 200-300 grand pretty quick. So in my experience, guys, I just would say I see these Fibonacci things just naturally. But yeah, I like Fibonacci. That's one way of kind of how we use them. So anyway, yes, you'll see that this is the hourly uptrend. So for us to get more aggressive on oil, we actually need to start breaking some of these things that are defining this uptrend, these higher lows. So if the market were to kind of reverse here and then finally break the new lower lows, then you'll see us get more aggressive, doubling and tripling our positions type of thing. Then we'll get more aggressive even on the day trade level. What other questions does anyone have? Lewis is asking, what about, I don't even know how to pronounce that, brother, Ichimoku? I don't know, it sounds cool. I've looked at the, what's the other one, the candlestick one. It has a Japanese name also. I should know that one. I have a hard time pronouncing it. We use that one a little bit. Yeah, so the answer would be no on the Ichimoku. I'm not sure about that one. Yeah, Hakanashi, that's right. Is that how you say it? I get a lot of volume profile questions. I've never used that, and I'll just tell you why. Maybe I don't understand all the points of it. I get that the markets will tend to kind of move towards those market profiles. To me, though, volume, we used to use volume a lot in trading, but it's not really helpful anymore because the dark pools and the computers are so fast that it just it's not meaningful. One, it's really hard to measure the volume, guys, nowadays. There's so many dark pools. I mean, I used to trade on eSpeed and BrokerTech, and which were the big two main institutional platforms. Cantor Fitzgerald ended up buying one of them. They were a big player in eSpeed. The guys that were in the World Trade Center, all that stuff kind of developed and moved over to eSpeed. So I could used to see the bid and the volume underneath the market, but then all these other different players started to come in, and desks like Citi would call me, and they had everybody was trying to give clients or traders the opportunity to hide their volume and hide their bids. So to me, even I could go in the market and I could have 100 million to buy at a level, guys, and everybody would show only 5 million or show 10 million. So even if the screens or the exchanges pick up that there's 10 million there actually might be 10 times that below the market. And in an instant, any pension fund, any money center bank could come in really literally in an instant and change the volume. And so to me, yesterday was a different day, right? It could have been a Fed meeting last Wednesday or earlier in the week. So to me, I don't really care if there was less or more volume last week, because we had a Fed meeting or we had ECB and BOJ the week before. To me, it gets a little too misleading. So I'd rather stay with time because we know that's one thing that doesn't change, and there's a rhythm there. And then price is very obvious. I mean, I teach my guys, there's no questioning which way the trend is. I'll show you how to identify the true trend, and it's just very simple. And when it breaks, it breaks. You can look at like gold, for example. Everybody has this level from yesterday when the market got smashed, but my guys know that we've been talking about 1310 forever. And yeah, it's support, but this is what defines the trend, is the TMS. So you're making higher lows at or near the 30. Making higher lows, again, at or near the 30. Then we held the lower bands. You held them twice. But anytime when you break these bands, usually the next move is to the 200. Or you can complete a pi cycle, boom. So my guys, we're waiting for this next bounce to short. We think the market either checks up here or holds these lows, but we might even go as deep as 1200, completing, again, this pi cycle. You can see it again on treasuries. I want to tell you guys a little bit about the company too. So I like sharing you with you. Let me just make this one last point in an effort to teach. We have a lot of signals, guys. I have an active trader program. We use a platform called Slack currently. That's probably going to be changing. But any day trade I do in the Forex markets, if I'm up trading London, you get all the real-time alerts. I have the swing trade program. I know a lot of people work. So we're swing trading short financials, long utilities. We have positions in treasuries that we're swing trading. We have positions in oil, gold. I mean, that's the nice thing about our model is we touch on a lot of markets. So these were my signals in the active trader room on the long bond. All right. And that service is, you can find it on the website. My company's website is Jenkins RM for risk management, jenkinsrm.com. It's dirt cheap, guys. I mean, I used to charge some of these banks 10 grand a month so they could have access to the same type of model. And literally, it's $149 a month. All right, you're getting the same type of institutional alerts. All right, and our best trade ideas, and we put analysis in there on a weekly basis too. So I would encourage you to sign up for that. I mean, it more than pays for itself, literally 2 or 3 times over, sometimes just in one day. But anyway, so I know this chart's a little bit messy. That's the reason why, is because these are some of our signals. But it was the same thing in the bond market. So if you guys were paying attention, Gunlock and some of these guys were all coming out and being very vocal when we were here in the market. And those guys are good traders. That's not my point. I like Jeff. I mean, I just don't pay attention to too much of that stuff because I think we have a better timing model. The point being is we broke these bands, and we knew that we might get the move to the 200, but at that point in time, we wanted to be buyers. And so it seemed that everybody in the media was thinking, oh, rates were going to rise. In our model, we were buying down here. And then you actually got the squeeze back towards the bands. And then again here, guys, here the bands rolled over. We got lower highs there again. And I think we're going to test this area. Wouldn't be surprised if the market held there. What other questions? I'll give you guys some examples of pi. Well, you can follow us too on our site. I have a Slack room or a trading room that's free. It's a community, a network of traders. My goal is I just wanted to help individual traders. I don't think Wall Street does a very good job as far as helping the new trader, helping even if you're managing money or if you're a hedge fund. We're building a network of professionals and independent traders. But you can join that Slack room for free, and then we talk about these types of things. I also have a live trading room that we just started. It's Monday, Wednesday. I trade the open 9 a.m. to 11. And so I'm teaching on this stuff. You guys can see me trade live. And again, I like to teach my traders to trade versus just giving them signals, because that's not going to last long term, right? Somebody could go away. You'll never develop as a trader. But here's an example. Everybody had pound going through the 200 and went through these highs. So I'm sure there was all kinds of stops running here and even people chasing going long. And we know that this is pi within a downtrend. You want to be a seller. Boom, it was the exact high. So I can show you this on the 1 minute chart. I can show you this on a yearly chart. This is why we do what we do in our model. What is the free trade room link? I don't know. I have to ask my marketing guys. If you go to jenkinsrm.com, go ahead and you'll see it there. The website's pretty clean. You'll see the live trading room. You can email me at trading. Can I type in here and everyone will see it? I only have a few more minutes. I don't want to run over. trading@jenkinsrm.com. You can feel free to email me there. And again, the website's jenkinsrm.com. So, and then I would say that the next thing I just wanted to talk about, if this interests you, if kind of some of the concepts make sense, I mean, I'm telling you guys, if you learn to trade with time and not just always focused on price, your level of consistency is going to change dramatically. I mean, I have a win rate right now running on our model on Forex, futures, and stocks and equities around 80. Let me see if I can show this real fast. Let's see. You guys can see this. I just posted this. This is some of our win rates. So this is in our active trader room. We had 36 wins. This is the last 90 days. All right. We trade a lot of pound yen, 10 winners, 3 losses. So that's an 84% win rate. 30-year, 5-year ultras, S&P, Dow, NASDAQ, oil, gold, nat gas, silver, coffee. I mean, we've got a lot of positions in a lot of different things. So we've always got stuff to do. There's always, there's always a bull market somewhere, as they like to say. 83% win rate there. Some of the individual stocks, ETFs we trade a lot of vol, 8-0 in the VIX. We made a lot of money this year there. So you guys can see some of the results. But the coaching is what I go over, and I would just say this last point. This is why I would encourage you. I do group coaching sessions, and the next one's here in October. It's for 4 weeks, 4 hours, twice a week. It's going to be Wednesday, Friday. You can sign up on the website there also. Just look for services coaching. And I'll tell you, this is important as a coach. If you're not getting these types of results on your win rates, if you're not consistent, usually it's because you have 2 or 3 different trading habits that are costing you. And most traders, I'm telling you, with working with traders forever, guys, is one, they tend not to actually journal or write down their trades. And we teach guys to journal on a chart. So one, they're not aware of the mistakes they're missing. But 2, I mean, it took me 5 years of just figuring out on my own of what mistakes I was making and trying to figure out, man, what am I doing wrong? Like, oh, okay, I see I keep doing the same thing. I'm too early on too much size. But you need to have a coach just like in sports, because you can't go inside yourself and figure these answers out, because if you could, you would already be there. So you need to have somebody outside that doesn't just tell you, hey, this is how to trade. I need to say, hey, are you doing this? Well, what's working? Have you thought about this? Do you feel like you're too early, you're too late? Those types of things have to come from the outside, and then you start to identify them, and that's how you can change and make the results. So not only in the coaching do I teach the model, I teach some of the things we went over, but I really work with my traders on the psychology of trading, getting rid of those losses and those bad habits. And when you get rid of the habits, then your winners are just consistently show up. And that's why I think coaching is really underrated, actually, in the industry. So that's part of what our firm really focuses on. Yeah, risk reward. It depends. I mean, I teach a. The question was, is what is the average risk reward? A lot of models use like a 3-to-1, 2-to-1. I have an add and reduce method I teach my guys where we actually add in the direction of our plays, and we actually get results where you get 10-to-1, 20-to-1. That's called the Jenkins add and reduce method. That's actually very high level trading. And that's something I teach in the coaching. But I think that's pretty much all the time I was allotted. I'm not sure. How do I switch it back over to you, Dan? If you guys have any other questions, just please feel free to reach out. And thanks for spending the time with me. And hopefully I added some value to your trading. And hopefully we can talk more in the future going forward. All right, Bill, welcome. Is there anything else I need to do here? Hey, John, you're welcome. Nice to meet with you guys, Stapleton. Thanks, Bob. You're welcome. Ivan, welcome. You're welcome, Rocky. Thanks, Hector. Appreciate that. I feel like I'm not doing something. Do I need to reshare this to switch this back over?
Hey, Jason, I got it. I think we're in shape there. So thank you very much for your presentation. Got a lot of great comments, so I think everyone really enjoyed it.
I appreciate it. Now
I want to be clear, just so that everyone knows, what's the best way to reach you? What's the best way to get started with you? Because you've got a lot of different offerings you mentioned on your website. If you had to choose one to say, if you're brand new to me, here's the best way to get started, what would you say that is?
Well, I would sign up for our active trader room. Again, it's a great value, $150 a month, and you're going to get signals sometimes 10, 15 times a day. And even if you're not trading all the markets, you're going to get a feel for our style of trading. And then a lot of traders are saying, man, I really see how you're doing this. I'm getting these concepts of time. And then, I try to work with people. Some people are full-time traders. Some of them have different schedules. And so from there, I can kind of plug you into the different coaching sessions or kind of what you want to, how deep you want to go as far as training and things. But yeah, the active trader room, that looks like the link, Dan. Appreciate that.